Here's how to turn $1,000 into $10,000 step by step. And once you've hit 10,000, you can turn that into 100,000, turn that 100,000 to a million, and so on and so forth. It's completely scalable. You can take it as far as you want to take it. So we're going to be writing options contracts. We're going to be writing the contracts, not buying them. And this is going to give us a high win rate, and that's going to give us consistent returns. And we're going to be writing the contracts on futures. So you want to pull up a list of futures underlyings that have options available to trade on them. If your broker doesn't display a watch list like that, then you can just copy down these ticker symbols and make your own watch list. And then it's very important to have IV rank on your watch list as well. And then you want to order the watch list from high to low IV rank. And you only want to look at things to trade that have an IV rank of at least 30. Over 30 is high, over 50 is very high. And the reason why IV rank is important is because it tells us where implied volatility is for that specific underlying with respect to the underlying itself over the past year. So you can tell whether the current IV for a specific underlying is high or low relative to its own self over the past 365 days. So we want to sell in a high implied volatility environment. The reason why is because high volatility means high option prices, and we're going to be selling the contracts, or another way to say it is we're going to be short the contracts. So whenever you're short something, you want to sell high, buy low, which means you want to sell when volatility is high and buy back when volatility is lower. Okay, now volatility is mean reverting, and it's contracting in the market about 80% of the time, and this is going to be very, very good for us, and I'm going to show you the perfect strategy to take advantage of this. So you want to go down the list and see what would fit well in your portfolio, assuming you've already got positions in there. If you've got an empty book, then by all means trade whatever you like. If you do have a smaller account, maybe stick to things like bonds, currencies, soybeans, things like that, corn. They typically require less buying power. If you have a larger account, feel free to trade whatever you like. If you have a smaller account, you probably don't want to go straight to something like crude oil. The IV rank on it's low right now anyway, so we're not even going to mock up a position on there. But you get the idea. So what we're going to do is we're going to have a look at natural gas today. It has an IV rank of 49.4, an absolute IV level of 57.2%. And we're going to then open up a list of expiration dates, option expiration dates for natural gas. And we want to pick an expiration date that's between 30 and 60 days out in time. So there's one here, 49 days away, April 25th. We're going to open that up, and now we are presented with the options chain. We can see we've got calls on the left, puts on the right. We have this orange horizontal line that shows us where the price of natural gas is with respect to the strikes that are going down the middle. These dotted blue lines show us our 1 and 2 standard deviation levels. If you look in the top right, you will see the IV percentage, which is 44.6%, and then in parentheses next to it you have the expected move, which is right now plus or minus 0.66, and that's also visually displayed with this vertical orange bar. And so when you are writing options contracts, you want price to stay away from those contracts. It's the opposite of if you were to buy the contracts. If you were to buy a call, let's say the 4.4, you basically want price to go as high as possible beyond 4.4, and the higher it goes beyond 4.4, the more money you're going to make. Okay, as you can see here, if you were to buy this contract, in order to start making money, you would need the price to be above 4.6. We're just going to assume this is 4.65 to where this bar goes green. This is at expiration, by the way. So at expiration, as long as the price is higher than this 4.65 level, you're going to make money. Okay, we're going to be selling these contracts, so we're going to be doing the exact opposite. Okay, so if we were to now turn this into a sell, as you can see now, we want price to stay away from this contract. We want price is currently here, and we want price to stay away from this contract, and as long as it does, we're going to make money. Okay, so that's the kind of mechanics behind selling contracts. You just want to sell contracts where price isn't going to go near them. Okay, and how do we know where price is going to go? Well, we know what the expected move is. We can see it here, and it's in parentheses here. So we just simply need to sell contracts outside of the expected move, and that's going to give us a high probability of success. I typically like to be around the 15 to 20 delta as a starting point, and I'm going to show you why delta is important. So if we look at the 20 delta to start with, we've got a 20 delta on the call side at the 5.2 strike, we're going to sell that, and we have a 20 delta on the put side at the 3.7 strike, we're going to sell that. As you can see now, our contracts are in and around the outside of the expected move. There is some skew here, and that is because natural gas has had this massive run up, but skew is fine. That's not a problem. The delta is the most important thing. So 20 delta on either side. And if you look in the bottom left corner, we have a pop of 79%. That means probability of profit at expiration is 79%. So we've got an extremely high win rate straight away. And if you want to get out of this position at 50% of max profit instead of holding all the way till expiration, then your P50, which isn't displayed for futures, but it's typically going to be 10 to 15% higher than your pop. So you're looking at about a 90% win rate if you want to get out of 50% of max profit, which is typically what I do. I very rarely hold till expiration, if ever. I always get out early. So we're looking at between 80 and 90% success rate here. And if we were to get filled at this mid price of 0.184, we would collect $1,840 up front. Our broker is going to automatically add this to our cash balance as soon as this order gets filled, and our broker is going to require 2.5k in buying power to open this position. So we're going to collect 1.8 and we're going to put up 2.5. okay, now you might be wondering, the title of this video says 1,000 to 10,000, and now we're talking about a buying power requirement of 2,500. Well, I'm going to show you what you can do to reduce your buying power requirement, and this will only work if you have a PM account or if you're using futures like we are doing here. So even if you have a small account but you want to use futures, you can still implement what I'm going to show you. So what we want to do is reduce our risk. Okay, we want to be more conservative, and we want our contracts to be further out. The further out they are, the further out of the money that your contracts are, the less buying power that's going to be required for futures. And the reason why this works for futures and PM accounts is because the margin or the buying power requirement is calculated a little bit differently. So for futures, it uses something called span margin, and that takes into account a lot of different things. So it takes into account the implied volatility level of the underlying, it takes into account how far out your contracts are, etc., what your CVAR would be. It takes into account so many other things as opposed to just equity, which is pretty just standard. It's just a pretty standard way of calculating buying power. Futures allows you to access span margin, which is far more dynamic. So without further ado, I'm going to show you how to reduce this buying power requirement from 2.5k down to whatever you want it to be. So let's just say we go way out to the 5 delta mark. So we take it to 6.4 on the call side, the 6.4 strike that is, and we go way out on the put side as well. We go to the 5 delta. So now we're at 5 delta on either side, 3.2 and 6.4, and what you'll see here, our buying power requirement has dropped all the way down to 1,000. Okay, our max profit has dropped as well, so we're gonna collect $400 up front on this position, and we're gonna have to put up $1,000. So we're getting a 40% return here. If you wanted to get out 50% of max profit, it'd be 50% of this number, which would be 200. 50% of 400 is 200. And now what's really interesting is if you have a look at our pop, it's at 95%. We've got a 95% chance of this trade working out in our favor. So if we were to, that's the expiration. If we were to get out at 50% of max profit, we're looking at a 98, 99, maybe even a little bit more, 98, 99+% chance of success here on this trade. You can get out for 25% of max profit. It's completely up to you. But basically, this is what you need to do, and if this was still a little bit more buying power, then you can just pick a different underlying, do the exact same thing, maybe pick a currency or something, or some bonds, do the same thing, just take it way out to 5 deltas. There's plenty of futures underlyings that you can trade for less than $1,000 in buying power. that's still going to give you very nice and high returns on your capital. Now, you might be thinking, okay, so what's the downside here? There is an unlimited loss potential here, etc., etc. So each contract, each contract has an expiration date, so 49 days out, right? So price can only move so far in that time period. We have a time stop loss. Okay, if you wanted to get out 50% of max profit, I'd also recommend getting out at, say, 21 days till expiration, or maybe half at the halfway point. Let's say you're in at a position where there's, you get in at 30 days till expiration. You might want to hold until 15 days till expiration, something like that. But the point is, you want to get in, have a high probability of success, and you want to get out early and get even higher probabilities of success, and just keep turning over your capital over and over again. Now, you do need to keep your buying power in check. So we've created a free position sizing template. The link is in the description. Everyone can get a copy for free. And the way it works is, you enter the size of your portfolio at the top. So say if it's $32,000, you then enter in the whatever the VIX level is. Say if it's 19.2, and then everything's going to be calculated for you. It dynamically works it out based on your portfolio size and the volatility in the market. When things are more volatile, you can be more aggressive. There's also less risk of a black swan event when the VIX is higher, so you can be more aggressive for that reason as well. As long as you're following this and you're not violating this outline or this guideline, then you're going to be absolutely fine over the long run. You're going to very consistently stack up profits and wins. If you do have a very small account, say if you've got like a $2,000 account or something, it's going to be very difficult to stick to these buying power guidelines. So you may have to be more aggressive, but that's completely fine. In a small account, when you're growing $1,000, $2,000 account up to $10,000, $20,000, $30,000, it's not uncommon to be, to have most of your portfolio allocated. Just because it's a smaller account, you just have to be more aggressive. There's no real way around it. But if you do have a larger account, 25k, 50k, 100k plus, you absolutely should not be violating these guidelines. And as long as you don't, you'll be absolutely fine. If you would like to learn in more detail about what we do and how we do it, again, click the link in the description. And this time, come over to EDS Premium and get yourself signed up. Inside, you will have access to this portfolio that I just showed you, and you're going to be able to see all the positions that we place, all the adjustments that we make, all the risk management techniques that we use. Everything is going to be there in real time. You can study it, reverse engineer it, or you can simply just copy. It's completely up to you. And when a position does move against you, it's not the end of the world. You can, finesse the situation. You can rearrange and move contracts out, up, down, and you can simply just keep rearranging things until you come out on top. So it's very common for us to have a losing position, although we don't have losing positions very often, as you can see from our initial probabilities of success. But every now and again you do have a losing position that you need to manage, and it's not uncommon for us to be able to turn a losing position into a break even or even a small profit. Managing risk is a very powerful thing, and all of that is in the EDS Premium. Everything is in real time, and you get full access to everything. There's also a full course, so no prior knowledge is required. We're going to teach you everything that you need to know from start to finish, and it's a private community as well. So if you get stuck, you can speak directly with myself or with other like-minded individuals. There's a 100% money-back guarantee. So once you have been through the full course and followed some of our trades for at least 6 months, if at that point you're not profitable, then we're going to work with you for free until you are, or you can just request a full refund. Right now it's $9.99 a month to join. The price will be increasing. We've already increased the price once from £1 a month to $9.99 a month. The price is going to increase again. This isn't a sales tactic. At $9.99 it is extremely underpriced for the value that you get, but we're just doing it to build up our member list. Um, and the aim of EDS Premium is to teach you the skill. We want to give you the skill. We don't want to keep you dependent on us. And once you've learned it, no one can take it from you. So it's a very powerful thing to learn. And we aim to get you to a point of where you are completely self-sufficient within 6 to 12 months. So with that being said, I will see you guys on the inside.